This accounting podcast is looking at balance day adjustments and how they actually affect a pre-existing trial balance, and then from that producing a statement of profit or loss and a statement of financial position. Now essentially we are just going to be going through the journals for this podcast and how that will actually impact your pro forma template for your trial balance. Now the first step that you need to do firstly is to work out what type of accounts all of your accounts are, and as we know they can be either one of four things: an asset, a revenue, a liability, an expense, or owner's equity. Now you can actually use your trial account which is in your textbook, and I have pre-put them in there already. Okay, so R is revenues, E is expenses, L for liabilities, O for owner's equity. Now the tricky ones I've actually highlighted here as well, and in bold. These ones are sales returns, the other one being trade debtors, GST clearing, drawings, accumulated depreciation, and provision for doubtful debts. Now these ones here are a bit tricky. So a sales return is a revenue item, and it is basically when a customer returns stock that you have either sold that is either faulty or has been damaged. So it is a negative revenue account. Your trade debtors is another name for accounts receivable. GST clearing is always a liability account. Drawings is a owner's equity and it will always have a debit nature. Accumulated depreciation is an asset. So accumulated depreciation is the total amount of assets that are declining in value. So for example, take my beautiful 2004 Commodore, which I bought in 2007 at the bargain price of $15,000. If anyone has actually seen that Commodore parked outside of the college, you will notice that it's no longer worth $15,000. It's probably not even worth $500. However, it's still got its hubcaps and also the fuel as well. So this one is basically recording the decline in value of assets, and it is always an asset account. A provision for doubtful debts is always an asset account, and it is basically providing for accounts receivables that do not actually pay you money. So there are just some tricky ones for you to actually look at. Step number 2 is to determine where to actually put these accounts. Now as we know, revenue and expenses will go in the statement of profit or loss, and I've called that P&L. Assets, liabilities, and owner's equity appear in the statement of financial position. Step number 3 here is then to work out what type of balance day adjustment you actually have, and there are 4. One is a prepaid expense, one is an accrued revenue, one is an accrued expense, and the other one being an unearned revenue. And look in your notes, you'll actually notice there, and I'm just going to scroll up here, that we have actually done a little pro forma cheat sheet here for you. And you should use that when deciding what type of balance day adjustments you actually have. So we are going to go through these now. So vehicles outstanding. Now the first thing you need to look at is what type of account is vehicle expenses. Is it a revenue or an expense? Now as it says here, is it an expense? So therefore you can narrow it down to 2 form of balance day adjustments. It's either a prepaid or an accrued expense. Now a prepaid expense will have paid in advance. Accrued expense will have things like amount outstanding, amount owing, and as you can see here, the key word here is outstanding. So this one here is going to be an accrued expense, and I'm just going to put in brackets AE. The next one here, advertising, includes amount of $1,200 that was for rental of a sign for 1 year. This amount was paid on the 1st of August. So you can see here, advertising is an expense, so therefore we need to work out, is this balance day adjustment a prepaid or an accrued expense? And because we have a period in time here, and this period of time is for 1 year, that is a giveaway sign that this is a prepaid expense. Other words is paid in advance and things like that. bank interest, as we know it is an expense, and we've got the word owing again, and so therefore it is an accrued expense. So that is your step number 3, to work out what type of balance day adjustments your additional information actually is. The next thing you'll have in your pro forma template is your journals. So step number 4 is to complete all of your journals. So in other words, you will have 3 journals in here because we've got 3 additional information. So with accrued expense, you need to work out what type of expense you are actually accruing. In this case, it is a motor vehicle expense. This number here is the account number from your chart of accounts, which is in your textbook, and we are going to increase this motor vehicle expense by $300. And the next account is accrued expense, which is a liability, and it is going to be a credit here for $300. And what we're going to do is we're going to adjust our trial balance as we go along and complete these journals. So we are going to do that now. So go over to your trial balance tab, and then you need to find out where your motor vehicle expense account is. And here it is here. So we've got here a column here called debit from journal, and the reason it is in the debit column is because of where the amount here is. So we are going to increase our motor vehicle expense by $300. So it goes in the debit from journal, and then because an expense which has a debit nature and this journal is on the debit side, we are going to add this $300 to the already existing amount that we've paid for the year of $1,112. So over here on balance, we're going to go equals 1,112 plus $300. And then we need to find out where accrued expenses is. Now all of your balance day adjustments, so in other words your accrued expenses, your prepaid, your unearned revenues, and your accrued revenues won't actually appear in here. So we need to actually create a line, insert a row. To do that, highlight a row, right click, and insert. Okay, and so we've got here an accrued expense, which is a liability, and that a liabilities go in the statement of financial position. It has an opening balance of 0 because we didn't have a balance in here at all, and it is going on the credit side of this journal. And because this is a liability, liability is having a credit nature, increasing. Because this is on the credit side of the journal, we are now going to add the 0 plus the 300 to make that. Now another thing which you need to obviously work out is to make sure that your journals always equal. So in other words, the debit side always equals the credit side. And as we can see here, both sides are equal to 300 at the moment. Now to get this, insert a row and then use your auto sum function, which is up here, and then we are going to highlight all of the column for debit from journal, press enter, and then with this little box drag it across. And that is our first journal done. The next one here is the advertising, which is a prepaid expense. So a journal here for a prepaid expense debit with the account number 3109, and then advertising expense being a credit for the same amount. Now what we need to work out is how much to actually put in here. And so I've done a little timeline up here for you to actually use. So as you can see here from the question, this advertising runs for a full year, so we paid it in August. So I've created 12 months worth of months for this prepaid expense. And to work out how much it is for a month, the total bill was $1,200, and since it's for a 12-month period, we are going to divide that by 12. So in other words, we are going to expense $100 per month for this advertising. Now the next thing that you need to work out is how much of this total $1,200 relates to the next financial year. And I've highlighted this in red. As we know, all balance day adjustments cut off at the 30th of June, which is what this month here represents. So our $1,200 of that relates to the next financial year is $200. Okay, so essentially when you did the original journal to pay for the advertising, you would have had advertising expense debit for $1,200, and then either cash at bank or accounts payable for $1,200. So at this moment in time, there is $1,200 potentially sitting in that account. We need to take out what of that $1,200 that relates to the next financial year, which is to 2 months. Okay, so my best advice when you're working out a prepaid is to draw a timeline for yourself of all of the months that this expense relates to. Step number 2, work out how much per month, and then work out how much of that total bill, in this case $1,200, relates to the next financial period, and that is the total amount which we are going to journal out as a prepaid expense. So if you go over here, we've got prepaid expense here of $200, which represents the July and August, and then advertising expense here for a credit of $200. So then we need to adjust this journal back in our trial balance. And so I've started here with a prepaid expense. Prepaid expense is an asset. An asset is found in the statement of financial position. It has a zero balance to begin with because there are no prepaid expense accounts in this trial balance. And we're going to put $200 here. And then we need to find our advertising, and it is up here. And over here we are going to put $200 here as a credit. Now with advertising being an expense and has a debit nature, this $200 is going to be subtracted from whatever we paid for the year. So we go equals 16,540 minus this cell, which is G7. Oops. Oops. So it should be D7, sorry. And so our amount here is $16,340 for advertising. Just to make sure that our both debit and credit journals actually balance, in this case it does, so therefore we go on to the next journal. And this one here is a accrued expense. And so we're going to have interest expense here with the account number 2504. Now you can actually have two individual accrued expenses here, but I've combined it into one because essentially we have interest expense for both on the overdraft and also on the loan. So I've combined them together and to give one amount here for $550. So therefore we need to journal this across to our trial balance. Interest expense isn't on here. Interest expense is an expense. It's going to come from the profit or loss. It comes with a zero balance, and therefore from there we need to work out where this 550, it is on the debit side here, so we're going to add that amount in. And since interest expense is an expense which has a debit nature, and this is from a journal which is on the debit side, we are going to increase it from 0 plus 550. And then what we need to do is find an accrued expense here. So we've already got one amount here for $300, so we just put equals, and then we can add the other $550 together. And so therefore our accrued expense is going to total $850. Okay, so then we need to then work out what are the balances for the other existing accounts that we've got in this trial balance. Now I've done some already. If there's no amounts in these journals here, it is using the amount that is given. Okay, so that is there, and equals 6524 for sales returns, equals $38,271, and then postage expense, rent expense, capital, I've used the same, cartage outwards, telephone, and then I've done some pre-existing ones here, GST clearing, and then accumulated depreciation, and then bank overdraft, bank loan, and then these are the ones which we have added to it. So that is how you actually complete part of your question. The next part after this is then formulating a statement of profit or loss and a statement of financial position, which I'll do in our next podcast. Thank you.